Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 263 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Good morning.
Good morning, Mark. Welcome to the podcast room.
Yeah, this is great. Yeah, for those people that are just listening on the platforms, encourage you to check out the video, at least to see the new setup. I think Jenna did a wonderful job of putting this together, and yeah, we're very official now. So
very official.
It's nice not having the laptop on the legs and
a
little more space. So yeah, pretty cool room.
Very cool room.
So yeah, very happy to be back in action here. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on July 31st. And just a reminder for newer listeners, we typically go through the performance of the major market indices that we track for investors and clients, talk about big headlines, current events from the past week or two. And then Matt and I each pick, 2 to 4 pieces of research that we want to discuss that we think are pertinent to what's going on in the markets today.
Well said.
So this actually, these performance numbers are just going to be for the full month of July. S&P 500 index is up 0.86% for the month of July. Dow Jones Industrial Average up 4.27%. The Nasdaq Composite Index down 1.57%. And the Russell 2000 Small Cap Index up 11.05% for the month of July. So we really saw this reversion of smaller and mid-sized companies performing a lot better than the larger cap peers, which is definitely a change of character, at least from the past year or so, right?
Absolutely. And I have a piece on this that actually puts it into perspective over the last 3 years. And what you're going to see is the ratio of performance of large to small. This downtrend has finally been broken by small caps. And the question is, will that continue?
Right. And I think if it does continue, I think it's the market sniffing out that lower interest rates are coming eventually, right?
Yes.
So just really quickly on interest rates and how they affect different sized companies in the stock market. If you're a smaller company, it's a lot harder to get financing at favorable rates, right?
Well said.
So if you're not a Boeing or Apple or Amazon or United Healthcare of the world, right, and you need to borrow money, you're not going to get the same rates as all those companies that I just listed.
Correct.
Right? So when interest rates are higher, that adversely, negatively affects smaller companies, right? So I think a lot of the reason for the small cap underperformance is because of this higher interest rate environment that we've been in over the past couple of years.
Well said.
So if small cap names do start to continue to outperform, I think we probably could expect lower interest rates, hopefully coming in September, which I'm going to talk about here in a little bit.
Love that.
Before we get to that, though, 3-month Treasury rate at 5.41%, the 2-year Treasury rate at 4.29%, and the 10-year Treasury rate at 4.1%. Also, yields indicating that rate cuts should be on the horizon over the next couple of months.
Correct.
Moving on to big headlines and current events from the week. Last week, we received the latest inflation data. This was the PCE report, or the Personal Consumption Expenditures report. It came in at plus 2.5% year over year, which is the lowest reading since early 2021. GDP also came in at a positive 2.8% year over year, which beat the consensus estimate of 2%.
Yep.
But the Fed does have a dual mandate, Matt, and those are price stability and maximizing employment. And unemployment is moving higher, actually quicker than we would probably like to see. But if you look at a chart at and unemployment, which we have in our August market outlook that is going out later today, it has been slowly and steadily rising. So that's something that we're going to have to keep an eye on. And while the Fed, for right now, seems like they've tamed inflation, they're going to have to deal with a rising unemployment rate, right?
That's right. And I want to start looking at the quality of these job numbers. So the first Friday of every month, the government reports these numbers, right? I'm going to be looking at full-time jobs because the headline number can be very deceiving when you're looking at part-time. But if we start to have a real decay in those full-time job numbers, Mark, that could eventually affect the psyche of the American consumer. And that's something that I think investors need to take note of.
Yeah, for sure. And the Fed just announced their latest rate decision yesterday. Again, that target range right now is between 5.25% and 5.5%. They left rates where they were, but Powell did hint that there could be rate cuts at their next meeting in September. And according to the CME Group on August 1st, so today, there's an 86.5% chance that the Fed cuts rates in September. And interesting to note that the Bank of England just cut rates for the first time today, first time in 4 years, actually. So the U.S. is kind of one of the last holdouts that hasn't cut rates yet.
Yeah, I mean, well said. You know, I talked about this on the podcast. I want to believe at this point it would be about 4 or 5 weeks ago. I showed this chart. It was from the Financial Times that showed these bigger periods of monetary easing and tightening worldwide. And those trends, Mark, usually last about 65 months in length. Well, let's think about what happened big picture over the last 5 years. We went through, not only in the U.S., but globally, a monetary tightening. And that wasn't just interest rates. There was other things behind the scenes that they tightened. And so one thing that's going to be a tailwind for investors over the next couple of years is the reversal of that. They're going to start easing again. They're going to start making things more loose in the monetary system. And I just think we got to be cognizant of that as an investor. What's a headwind? What's a tailwind? And I would actually say that at least here in the U.S., we're going to be embarking where monetary policy again will start to be a tailwind for risk assets.
Right.
Good way of saying it?
Yeah, for sure. Lastly, interesting stat from the Insurance Information Institute. This was back on July 24th. It said that 20% of Floridians are self-insuring homes, up from 8% in 2016 due to the high cost of insurance.
That's a dramatic number.
Yeah, the housing market in Florida is kind of like unlike any other across the U.S., right? Because it's just so expensive to have insurance because of hurricanes, right?
That's right. And any close proximity to water, it just skyrockets or it's not even available.
Right. And I saw something on X last night, actually, that there's another storm heading towards Florida, I think within the next week, that not a lot of people are talking about, that could do some significant flooding damage at least. So hopefully that doesn't happen. But
yeah, and we still got 2 months. I mean, I'd argue we still got about 8-9 weeks of quote unquote hurricane season.
Right.
It's, it's. I think these things go through bigger long-term cycles. Again, I'll say it. The 90s was a lot of hurricanes, and these things just tend to go through cycles.
Yeah, they do. Moving on to tweets, articles, and research from this week. First thing I had was a article from the Social Security website on ssa.gov on July 12th titled Social Security Announces Upcoming Changes to Accessing Online Services. Some more along the financial planning topic of the week, since we don't have one dedicated at the end of the show because we have a lot of information to get through today. Social Security Administration announced that customers who created an online account, which is the My Social Security account, before September 18th of 2021 will soon be required to transition to a login.gov account to continue to access their online services. My Social Security is a safe and secure way for people to do business with us, said Social Security Commissioner Martin O'Malley. We're excited to transition to login.gov to access our online services, streamlining the process and ease of use for the public. Account holders are encouraged to sign in now. When the user logs in, they will be presented with an option to easily transition to login.gov. Once their account is successfully linked, a confirmation screen will appear, and they will have immediate access to their personal My Social Security services or other services that they're attempting to access. Existing login.gov or ID.me account holders do not need to create a new account or take any action. My Social Security accounts are free, secure, and provide personalized tools for everyone, whether receiving benefits or not. People can use their account to request a replacement Social Security card, check the status of an application, estimate future benefits, or manage the benefits they already receive. So we use this a lot for clients, Matt, when people are getting closer to retirement and it's time to make that decision of, okay, do I take Social Security early at 62? Mm-hmm. Do I wait till my full retirement age, which is anywhere between 66 and 67 and 8 months-ish? Mm-hmm. Or do I delay it the maximum amount until I'm 70?
Yep.
And what we want from people is on the My Social Security website, you can get an estimated future benefits PDF that shows you what your approximate monthly benefit is going to be at certain ages, right? Between 62 and 70. So again, just more of an FYI for people so that they're not confused if they can't access their Social Security benefits through their normal login. Yeah. Jenna will, in the show notes, attach the link to this article where people can go and change this if they need to.
I wasn't aware of this.
Yeah, I wasn't either. Second thing I had was a blog post from Callie Cox, who we just a month or two ago had on the podcast, titled Rate Cuts Are Coming. This was back on July 15th. So she says, after a third straight month of chill inflation data, markets now overwhelmingly believe we'll get a rate cut in September. Let's begin with a primer on the Fed and interest rates. Interest rates are what you pay to borrow money, or what people or banks pay you to borrow your money. Few understand that a small group of academics in DC has a big hand in setting these rates. I'm talking about the Federal Reserve. The Fed exists to balance the economy through interest rates and other nifty tools in order to keep Americans employed and able to afford things. The Fed's biggest tool is the federal funds rate, the rate the banks pay to borrow overnight from other banks. They adjust this main rate through cuts and hikes to either stimulate or cool down the economy. A lower Fed rate typically means cheaper loans across the board, and when borrowing money is easy and cheap, you're less incentivized to save and more willing to spend and invest. The increase in spending juices the economy, boosts innovation, and lifts spirits. Everybody is happy until the pot boils over. That boiling point was in 2021. The economy was running too well to the point where prices were rising quickly and everyday things were becoming unaffordable. In response, the Fed started raising its main rate in March of 2022, eventually pushing the rate from 0 to a blistering 5%. It was painful but necessary. Stock prices dropped, mortgage rates soared to 8%, spending slowed, businesses closed, layoffs surged, and the vibes were just generally off. In summary, Americans spent less and saved more, which helped inflation slow down to pre-COVID levels. The last few times the Fed cut rates were in response to scary events like COVID and the Great Financial Crisis. Stocks ended up falling further after the first cut before eventually recovering. But don't freak out just yet. Right now, a good bit of Americans are employed and they're spending money. It doesn't look like we're in a recession or even close to one. If history proves correct, we could see the stock market continue to move higher in a slow, grinding fashion. Rate cuts don't always lead to financial irresponsibility, nor do they always lead to a market crash. So I thought it was good just to have another kind of recap or debrief on the Federal Reserve rate cuts, how they factor into stocks and the economy. Like we talked about earlier in the show today, widely expected to see some rate cuts over the next couple of months. I think it's a matter of how much and how quickly they're going to lower rates. And I think you've discussed several times on this show before that the slower and more gradual the rate cuts are, the better stocks do, right? As opposed to, oh my gosh, there's an imminent crisis right now. We need to cut rates by 2% over the next 2 months. That typically is a negative for the stock market.
Yeah, that was all very well said. Great piece by Callie. Great analysis, Mark, on your end. And one thing I want to add to this is a topic that when Aaron Kramer was on the podcast with me just a couple of weeks ago, I highlighted a lot of the data points that once that first rate cut comes, in the lens of history, bad things tend to happen for the economy. And I communicated a lot of statistics on that podcast. And I wanted to get well ahead of all the clickbait you were going to see in the middle of September. And what's it going to say, Mark? When you look at history, first rate cut spells doom for the economy. Like, you know, copy and paste. So with that being said, I'll be very interested to watch the economic data from, say, right around the election into the first to the second quarter of next year. What's some of those high-level things we got to pay attention to? How's the consumer doing? What's those job numbers looking like? What is corporate America telling us during those quarterly conference calls? A lot of good insights real time. I just think ultimately, can the Fed navigate a soft landing? It's possible. And for our newer listeners, what's the definition of a soft landing? That's where you raise interest rates as quick as they did without causing a deep recession. And I'll be curious, so far, they have really surprised Wall Street. And we'll see if that trend continues going into next year.
Yeah, for sure. And going back to, if the first rate cut is in September, and typically stocks are weak after the first rate cut, that coincides with, weak seasonality right before a pretty big election in this country.
Well said.
So again, I just don't want people to be surprised if the market continues to sell off from this point, or either rallies between now and end of August and September, and we get another pretty good sell-off. So I think that should be expected at this point.
I would agree.
Last thing I had was a tweet from Grant Hawkridge on July 16th. Jenna will throw this up on the YouTube video and put this in our show notes. He says, Whaley Breadth Thrust has been triggered. The Whaley Breadth Thrust indicator is triggered when the number of 5-day advancing stocks in the market exceeds the number of 5-day declining stocks by about a 3-to-1 ratio.
Ooh, keep going.
So just in simple English, more stocks are going up than going down significantly, right?
Breadth participation could be used.
Correct. So since 1950, 1 year after this signal, stocks have never been lower. I want to put a disclaimer out there that the sample size is small, and the Whaley Breadth Thrust has only triggered 15 times since 1950, according to Grant.
Okay.
But again, if you look 1 year out, markets have never been lower. If you look 6 months out, markets have only been lower one time, and that was in January of 2009, and we all know what was going on at that point in time, right?
Oh,
yeah. Again, we've kind of over the past 3 weeks, I think, Matt, gone through this transition of only, the top 10 to 15 stocks in the S&P 500 really outperforming anything else to, oh my gosh, all those names have pulled back, and a lot of the smaller names and a lot of these indexes have picked up that baton, right?
Yes.
So long term, I think it's a really healthy thing for the market. So just interesting. Again, this indicator has been pretty spot on if you look a year out. Doesn't have to continue to be spot on because it's only happened 15 times. But, when we're talking about the market and we're talking about breadth, meaning there's more stocks participating to the upside than the downside, that generally is a good thing.
Absolutely. We highlighted on the podcast a couple of months ago. I mean, if you take the 503 components of the S&P 500 index, the stat I threw out there, you strip out the top 7 performers, the index at the time I quoted it went from being up mid-double digits to up like 4%.
Right.
And you literally had to go back to the late 90s during the build-up to the tech bubble to see any sort of narrow market like that. And I think it just goes to show you that these things go through cycles. And where has all the earnings growth come from in the market? Well, it's come from not only tech, but a couple subsectors of tech. And, my 2 cents is as long as those sectors can keep up those growth rates, historically speaking, those sectors should continue to outperform. But the minute they show any sort of disappointment, that's when you're going to see potentially a larger rotation.
Right.
So here's, are you okay if I transition?
Sure.
All right. So the first thing I have is a great quote by a very popular blogger. His name is Steve Burns. Okay. And Steve posted this on July 25th. I've been talking about this in the podcast. His tweet was this, quote, "Everyone says they want to buy a pullback until it actually happens." And so I want to throw this out there because, we started off the year, January, February, and March, market did great. We had a sell-off in April. depending upon the index you look at, let's just call it a 6% sell-off. Everyone hated the market then at the end of April. What happened in May? Rallied right back, okay? I just want to throw it out there. There's still a lot of investors that are light on risk allocations. I'm not talking short-term money. I'm talking long-term retirement money. And they're light on risk because of the proximity of 2022. And you're going to continue to get plays at bat. And I just want to throw it out there. The time it feels uncomfortable to make that buy is usually when you need to buy. Just want to throw that out there.
Yeah, and now's a good example of that. You know, tech has sold off pretty substantially. I think 10 or 11% from the highs set earlier in July, and that's scary, right? Because that tech has been the one that's leading this market forward. So I think immediately everyone's like, "Oh my gosh, it's over."
Yes.
You know, it's over,
Sure.
right? But yeah, like I feel like we talk about once a month here is that, you know, usually during pullbacks, everyone says they're waiting for the pullback, but they think it's going to continue to happen. Well, the market's only down 6%. I'm going to wait for it to fall 10%, or I'm going to wait for it to fall 15%.
Which it could do both those, right?
And then it gets to 15%, they're like,
I ain't gonna do it now.
This is turning into something way bigger than
That's
than
right.
this. So, yeah, it's a good reminder.
My second piece is interesting correction statistics from Seth Golden that caught my eye. Seth, a friend of the podcast, posted this on July 26th. And here's what he said. He goes, the S&P 500 index has cycled from being 5% above its 50-day moving average to below its 50-day moving average in just 6 trading sessions. Again, this is on July 26th, Mark. He says it's rare, but every single time that has occurred throughout history, 6 months later, the S&P 500 index is higher. So Jenna's going to put up this chart for our YouTube viewers. This will definitely be in our show notes. This is from Seth's firm, Sentiment Trader, and you're going to notice the statistics of this. It's not common. Got about a baker's dozen or so data points on this. It's when you have kind of a quick move in the markets. But when you look at this data point, on average, 6 months later, depending upon how you slice and dice the math by median or mean, the market's about 10% higher. I just want to throw it out there that when you see those sort of corrections, it doesn't immediately spell imminent doom for the market.
Yeah.
Okay? Anything you would like to add?
No, I don't think so. It's an interesting chart. I don't think I've ever seen any stat like this. So,
yeah, I think it was kind of interesting. So the next thing I got is another data point I think individuals should watch closely. You at the top of the podcast, Mark, were talking about employment, okay? Well, a subsection of employment that tends to be very economically sensitive is trucking employment, okay? And there is some traders I follow on X, Game of Trades is the firm, and they posted a chart of trucking employment going back to the early 90s. And they're starting to see some weakness in the numbers. Now, well, does this immediately spell doom that a recession is on the horizon? It does not. But the data point is definitely concerning. Now, if Gamer Trades were in this room, this is how I would counteract. When you look at things like rail data, like railroad, their numbers are very high right now. So one could say, is a lot of that being done by better logistics, and it's being done on rail than it is by trucking? When you look at the data of shipping, dry bulk shipping, those rates are a lot higher than they were a year ago, which would be counteractive to this data. Mm-hmm. So I just want to sit there and say, this is something that historically would be concerning. I'm not seeing confirmation in other areas of transport just yet, but it is something that I think investors should be keeping an eye on.
Yeah, and even just to dig a little deeper, maybe for people that are new to the podcast, this stuff is important to the economy because, if trucking companies don't need as many drivers, one could make a inference that there's not as many goods being shipped, right? And that's an indicator that the economy is slowing down. People aren't spending as much, right? Yes. So I think consumer spending is going to be interesting to watch between now and the end of the first or second quarter of next year, because I think we're getting a little bit of a slowdown, but nothing alarming yet.
Yep.
But if we go through the holiday spending season here in a couple months and consumers really pull back, then it might be like, okay, this might be something to pay attention to.
So deeper.
This isn't a timing thing. It's just, hey, if there's not many people driving trucks to get goods across the country, then a slowdown might be coming.
Perk up, right? So my last piece is the performance spread. I talked about this at the top of the podcast, Mark, the performance difference between small caps and large caps. This is going to be a tweet by a bar chart on July 25th. July 25th was a hot day, man, for a lot of my stuff because there was more extremes in the market that day.
Yeah.
So what bar chart put together here is small caps illustrative by the IWM ETF. That's a small cap index. It says it finally broke through a 3.5-year trend line against the SPY, which is a popular S&P 500 index ETF. Jenna will put up this chart for our YouTube viewers, Mark. This will be in our show notes. And what it's illustrating is finally this relative performance of small to large. Smalls are finally kind of kicking it into gear. And at the top of the podcast, when you highlighted some of those performance numbers for July, and you got small caps up low double digits, and a lot of those large cap indices either slightly down or just slightly positive, you're really exemplifying that. And it goes to beg the question, as you insinuated, is maybe the Fed cutting interest rates starting to get investors excited again about small caps and what their prospects are from a profitability standpoint? Or is this more a reversion to the mean trade in general? You would speak more intelligently on that topic than myself, being our chief investment officer. Any other thoughts you'd like to share with our listeners and viewers?
Yeah, no, I think it's positive for any investor that, there's kind of at least a reversion to the mean, just because large cap stocks have outperformed small cap stocks for a long period by a significant margin, really. Mm-hmm. If you go back to the end of June, I think the QQQ, the Nasdaq 100 ETF was up, almost 20% or something like that, and small caps were up like 4, maybe.
Yeah.
And you just see how big that shift is in 1 month. And I think that's why it's garnered most people's attention. It's like you usually don't get a index that is up 11% in 1 month.
In 1 month.
So that just shows, I think, the strength behind this move, which I think is good, and it could, turn this trend around, which is fine. It's not something to be concerned about. It doesn't mean that all of the large cap stocks or the S&P 500 has to crash, but it just might be time for smaller names to outperform. And, smaller names can outperform and large cap stocks can still go up. It doesn't mean that there's a negative inverse relationship, but it's been longer than normal, the underperformance in small caps. And typically when you get small caps going, it's a risk on trade. So I think, this is a good thing, but it's all about market rotation, right? So, I think we've said several times on the podcast before, it's not one of our quotes, but rotation's the lifeblood of markets, and it keeps markets going and continues uptrends. So it's going to be interesting between now and the end of the year to see if small caps really kick it into gear, and if small caps end the year higher than large caps or larger than tech. That's going to be really astounding because it hasn't happened in a while.
That's right. And I'd argue a lot of investors just are underallocated to small and mid caps in general. I just feel that way. And I'll be very curious if that starts to occur. Do you start to see more of a chasing of that trade in 2025?
Yeah.
Hey, I'm being left behind. Look at the returns in my 401k on this XYZ mid cap and this ABC small cap. I think I want to get into that.
Right.
And you see how that chasing begins to happen in the latter stages of the rally.
Yeah, and I think another thing that's important to note is, small caps, a lot of them become mid caps, and then the mid caps become large caps. I know there's a lot of IPOs today's day and age that are, $80 billion or $100 billion, so they just jump right over the small cap range. But, some of these small caps, I think in 10 years, they're going to be large cap names, right? So I think that's also important to remember. But, we'll have to wait and see. Like I said, I think a lot of it is dependent on rates.
Yep.
I think this is a good get too excited just yet. This is, again, just a 1 month snapshot, right? For
That's
small
right.
caps.
And just remember, small caps historically tend to be more volatile than their larger counterparts. So just know that, when corrections occur, small caps historically correct more to the downside than the large cap counterpart.
Right, and that should be expected at some point in August. I mean, 11%, like I just said, is a really, really big move for an index in a 1 month period. So
Yeah.
it wouldn't surprise me if small caps were flat for August or slightly negative, just because of how violent
To
the
digest
upside
that move.
was. Correct.
Yes.
So, all right. Well, anything else that you want to mention, Matt, before we leave it there for the week?
We are in one of the busiest weeks for earnings season for the second quarter. So with today being August 1st, you have a lot of those S&P 500 component companies reporting earnings.
Amazon and Apple are tonight.
There you go. If you're going to see, some more volatility on some of these individual names, and if you're wondering, wow, why'd that stock move so much up or down? It's probably because they announced earnings.
Yeah.
And so for some of our newer listeners and viewers, you got to remember that every quarter, these publicly traded companies, when they report these earnings, they are sharing information that's new to the market. And that's not only their financial results for the latest quarter, but also forward-looking comments that they share with investors during these quarterly conference calls. These conference calls tend to occur after market hours. And so what happens is the next trading opportunity, the market is then reacting to that news that is fresh. So for those that are wondering, why does it happen that way? That's normally the mode of operation, and we're just in the peak of earnings season, which makes people's lives like Mr. McEvely here, who's a chief investment officer, very lively during these times of year.
It does. And I think one thing that we'll be paying attention to, and I think a lot of people will be paying attention to this earnings season specifically, is the C-suite comments, especially for consumer discretionary names.
Well said.
What are they saying about the American consumer? Because we
Well
get
said.
that data every month and every quarter, right?
Yep.
But it'll be interesting company by company to see if there's another consistent theme of them blaming bad earnings or poor revenue on the consumer.
Yeah, well said. What's neat too is there's always like what I call late reporters in earnings season in different industries. And when you started speaking, it made me think, and this is not a recommendation for or against this name, but for example, Costco is a late reporter in earnings season. So even though people could care less about what Costco earns, they pay attention to the conference call about what they're saying about the consumer, right? And everyone wants to protect the cost of that $1.50 hot dog.
Yeah, for sure. There's Costco and Walmart, Amazon. Those are kind of the bellwethers, right, for the American consumer.
Yeah.
So yeah, actually, speaking of the hot dog, I saw on X last week, I think it was, this guy was eating a Costco hot dog, and instead of a bun, he wrapped it in a piece of Costco pizza. So it's the pizza dog.
I love this.
So
What does he have, like this secret menu, like In-N-Out Burger?
yeah, it must be. So he might have started
It's a
a
version
new,
of going animal
new
style.
trend. Yeah. So
Love that.
thanks for mentioning that. Still an earnings season for the next several weeks. So expect volatility to be a little higher than normal.
Well said.
But yeah, we will leave it there. Last thing I want to say is that if you want to create your own podcast, use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth, all lowercase, no spaces. Also, if you're looking for an AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. Use the link in the show notes below to purchase your subscription and make life a bit easier. Thanks, everybody, for listening to episode number 263 of the Independent Advisors Podcast. We will be back with you next week for episode 264.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.